Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. Now Hurricane Ian is taking aim at South Carolina. The storm's winds picked up to 85 miles an hour overnight, and it's expected to make landfall today near the historic city of Charleston. Ian caused catastrophic damage in Florida, where it came ashore as one of the strongest hurricanes ever to hit the U.S. The storm flooded towns on both coasts and wiped out entire neighborhoods. An unknown number of people are still believed to be trapped in their homes. For the second time in 2 weeks, there was a reminder of just how quickly risk appetite is evaporating from credit markets. A $3.9 billion debt sale for the leveraged buyout of telecom provider Brightspeed collapsed. There wasn't enough demand from investors. Last week, a group of lenders crystallized losses of around $600 million on the take private of Citrix Systems. They agreed to keep on their books around $6.5 billion of debt that they weren't able to sell. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy.
Ritika, thank you very much indeed. Let's stick with the theme of what's happening in the M&A world. Brightspeed, that debt failure story following what's been going on with Citrix. There's a long line of other businesses that are going to be facing similar problems in terms of the buyouts that were priced earlier on in the year and are now ultimately coming into a much stickier market. Mark Cooper, Solomon Partners CEO, joins us now, a specialist in M&A. Mark, what do you make of what is happening here? Is this just a period of indigestion that the market is going to have to go through, a resetting of expectations? After we found a clearing price, we can move on. Is that too simplistic, or is that basically what is happening?
I would never, good morning, hope all is well. I would never say anything that you said is simplistic. But I would say it's deeper than that. So those are transactions that were consummated a while ago, and the debt markets obviously have faltered dramatically, largely given volatility and largely given increasing interest rates and people's appetite for risk. So it's not a function of simply clearing the balance sheets, the banks, so that they can get back into the market. It's really a question of when we get to equilibrium. When do we get to a point where people are comfortable that there is a consistent view on what rates should be, and that banks can absorb credit and sell that credit into the market with consistency. That won't happen for a while.
What does a while mean?
Well, a while means is, I think, in my view, when we all believe that we have a certain view as to where the interest rate environment will end up. So until the Fed stops increasing, I should say, until the Fed gives the signal or gives the market the signal of some consistency in rates, it's very hard for banks to be willing to take these obligations on their books and take the risk that's over time before they sell it. Understand what banks are doing here. They're not buyers of debt, they're sellers of debt. So all they're doing is acting as a conduit to the public markets in order to effectuate transactions, and there's always a time delay. So their issue is simply, can I sell it, and what's the clearing price? And what they've realized over the past 6 months is they obviously were wrong on clearing price. Not their fault necessarily, since the market has made an unprecedented move in increasing interest rates, but this is just the vagaries of our business. So I would tell you that the public debt markets for below investment grade credit is going to be shut for a while.
What does that mean for deal flow, Mark?
Well, it means some of the larger transactions will have a more difficult time getting financing, because generally speaking, that's where they got their money from, which is the fully distributed bank markets. But the good news, and we're seeing this today, the good news is the private credit markets have grown dramatically. I mean, these were, it was an $80 billion market back in 2008. It's an $800 billion market in the U.S., $1.2 trillion globally. And these institutions are buying credit. They're underwriting credit and buying risk. So they don't care about I mean, they care about where interest rates go, but they're looking at a long-term investment, putting money to work. And so while they're tightening up, and yes, the increased volatility in interest rates doesn't help their cause, and so they widen spreads, and they can get more conservative given some of their concerns about the economy. They're still putting money to work, and we're seeing, even for larger transactions, and there've been a number of them, that they've stepped up and put money to work.
Mark, what about the UK? It feels like it's, on one hand, an entirely different beast. On the other hand, signals what could happen as liquidity is rapidly withdrawn, but there's still money floating around from the government. What are you noticing there?
It's a more complex situation, and I think the difference between the UK market and our market is the economy there has been troubled for quite some time. So people talk about Ms. Truss's decrease in taxes as being the instigator for the pound falling, but in fact the pound was falling well before that. So theirs is an economy that needs a bit of stimulus in order to get back in competition with the U.S. You know, we have our issues with our own economy, but it's not terrible. It's not bad. I mean, there are many companies that are doing quite well. Some of the consumer cyclicals are having problems because, you know, they were buying into what they thought were pandemic level demands, which hasn't come to fruition. Not a huge surprise, but, you know, they were chasing sales, and they'll have to restructure, and that's fine. But we'll come out of this okay. The UK, you know, they have to get that dollar-pound parity or dollar-pound relationship back into a more historic level, or else they're going to have a tough time driving their economy.
Mark, are there any opportunities outside the United States that you're looking at right now? As you say, the currency alone is making assets abroad cheap. Is that where the opportunity lies right now? Or do you think the volatility is just going to scare people off?
So when you look at corporate buyers, and to the extent that they have foreign companies on their radar, this will be a very good time for them to pounce. Obviously, you're getting a 20% discount by virtue of currency. When you look at where the big money is today, which is in the private equity market, and there's still an enormous amount of dry powder in the $1 trillion range, that's still focused domestically in a significant way. Now, obviously, there are euro-based funds that invest overseas, but that's not taking advantage of cross-border interest rates.
All right, Mark, we really appreciate you getting a perspective. It's going to be a fascinating few months, or the next year, actually. Mark Cooper, Salomon Partners CEO, thank you so very much for joining us. This is Bloomberg.
So we're approaching the end of the session, end of the week, end of the month, end of the quarter here in Europe. And the final day, Stock 600 up by 1%, 387. It's been a tough quarter. The pound bouncing back a little bit. I wouldn't take that necessarily as a vote of confidence in the government. There are some serious concerns that exist, certainly here in the UK. And then I want to flag what's happening with Eurozone inflation. 10%, we've got double-digit Eurozone inflation. If you take a look at what's happening within the market, the Dutch inflation number today, 17%. You go further north into the Baltics, it's even higher. Vincent Mortier is going to be joining us in the next hour to talk about what is happening with these markets. We'll get his take on what is going on here. He is the Amundi Chief Investment Officer. That's coming up from Paris next. This is Bloomberg. Friday, the 30th of September. European stocks broadly higher, but it's been a brutal week. To be honest, it's been a brutal few months. The countdown to the end of the quarter starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So a little rally for European stocks into the end of the week, into the end of the quarter, into the end of the session, but it's a whimper rather than a bang. It has been a brutal quarter for European equities. It's been a brutal quarter for European assets. The euro under a little bit of pressure today. Some really strong inflation data, though piling pressure on the ECB to do more. We've got a headline number for the whole of the Eurozone that is now in double digits. The German number is frightening. If you go further north into the Baltics, it's even worse. Take a look at the Netherlands number. Even that was pretty alarming today. Euro dollar 97.96. We have seen a little bit of a bid back into the UK gilt market today, despite the fact that actually we haven't seen the U-turn that the market was anticipating, maybe from the government. There was a meeting with the OBR a little bit earlier on that delivered absolutely nothing. We'll see how the next quarter starts next week. We'll see whether the market is prepared to give this government the benefit of the doubt. A lot to discuss over this weekend on that subject, Alex.
Well, here inflation, let's pick up on that thread you were just talking about. We had high inflation here for the PCE, but spending was still holding up. So the S&P kind of in nowhere's lands, up by about 0.4%. But it's been a terrible September, and it's been a terrible quarter. We're now at a quarterly string of losses for the S&P, the likes of which we haven't seen since 2009. Some idiosyncratic stories that are quite fascinating. One is Nike. The jump in inventories led to the stock sell-off. I mean, there's a huge gap down if you look at a two-day JIP. Carnival also looking at adjusted net loss for the third quarter of as much as $688 million. That's almost double what the street had been expecting. That stock getting slammed, all its peers getting slammed as well. You were mentioning the euro, so I wanted to end on the dollar. The Bloomberg dollar index up, well, relatively flat. But we're looking at the best month, the best quarter on record for the dollar, going back to when the index was started back in 2005. And this, I feel, is a great example of the rest of the shakeout in markets throughout the last quarter.
That's been the story, hasn't it? That dollar strength story just rippling around the world and having a massive impact. A lot of this as well, this volatility we're seeing in markets, the volatility we've seen in the markets over the last quarter, certainly centered on what the story has been out of Ukraine. The Russian war there has had a meaningful impact on assets. Today, once again, the US ratcheting up the pressure, sanctioning the head of Russia's central bank, Elvira Nabiullina. We've also got the Deputy Prime Minister, Alexander Novak, being sanctioned as well. This, of course, in response to Vladimir Putin's annexation of territory in the east of Ukraine. For his part, Vladimir Putin is vowing that the annexation is irreversible as he prepares to formalize Europe's biggest land grab since World War II.
The people have made their choice, and I'm sure that the Federal Council will support the proposal of admitting 4 new regions, 4 new entities of the Russian Federation, because it is the power and the will of millions of people.
Vladimir Putin speaking earlier, joining us now from Brussels, Bloomberg's Maria Tadeo. Maria, we're starting to see the response coming out of Washington. How is the EU going to respond to this annexation?
Well, Guy, more sanctions are coming, and the European Union repeating again that Vladimir Putin has decided to escalate the nature of this war and repeating that they will support and defend Ukraine's territorial integrity. And by the way, Guy, the 4 regions that Vladimir Putin has decided that he will annex and claim victory over today, the fight is still ongoing. It's always worth stressing the propaganda element that goes into this. Now, when you look at the Ukrainians, however, we did hear from President Zelensky saying there is nothing to talk about with Russia as long as Vladimir Putin is the president of the Russian Federation. And also, and this could get tricky and complicated, he says Ukraine will double down in its application to enter NATO. Now, the timing of this is important, Guy, because in about an hour's time, there is a press conference by the NATO Secretary General Stoltenberg, allegedly on the Nord Stream leaks and the explosions that took place earlier in the week. But this will now put him in a difficult position because, remember, there's a number of NATO countries that fear potentially that NATO could get drawn into this, and that is a whole other level of escalation in this war.
Yeah, it is quite worrisome. At the same time, Maria, you had European leaders meeting to discuss an energy package. They finally agree on something. Is it going to work? What is it, and is it enough?
Well, they have agreed on something, and the reality is this is the roadmap that was laid out by Ursula von der Leyen. The market knew this. It was very well digested, and it was very well priced in. You look at demand destruction, 10% overall. That is the target, a 5% mandatory target to the windfall tax and all of this. But the real question remains the gas cap. And Alex, there is no consensus around it. There's a number of countries that really want it or are pushing for it. The French, the Italians, the Spanish, the Belgians. But the Germans, they say they still have reservations about the implications that it could have on the supply.
Maria, thank you very much indeed. Really useful updates. Maria Tadeo joining us from Brussels. As we've been watching this story unfold, of course, we've watched the implications for Europe unfold. Today we got another reminder of what this conflict, what this story is doing to the energy markets and by extension the inflation picture out of Europe. We got numbers out of the euro area higher than anticipated, 10%. We did get some more positive numbers out of France. That number dropped, but Germany remains very elevated at 10.9%. The Spanish number yesterday dropping as well. But the further north you go into the Baltics, the numbers remain very, very elevated. And also you then have to look at what even the Netherlands is having to experience right now. It's dealing with 17% inflation. And this takes us back to our question of the day. As we continue to see these numbers, and central banks having to respond to them, what does that mean going forward from here? We've just had a brutal quarter as the market has tried to price that in. What does the fourth quarter now look like? Well, let's try and answer that question. Vincent Mortier is Amundi's CIO, and he joins us now from Paris. Vincent, we've just had a really difficult third quarter. We've got inflation that is spiraling in Europe. What does the fourth quarter look like to you?
Well, indeed, this quarter, the third quarter, we had almost only negative news, so the market repriced and reacted accordingly. And I would say now we are reaching levels where markets are a little bit oversold on equity. So we expect some stabilization, even though we can have some further leg down, 5-10%. But it's very difficult to time the bottom, of course. But we expect a kind of stabilization on rates, on currencies, that's very important, on commodity prices. So Q4 might be a quarter of transition. Mm-hmm. And it will be very important to keep current levels in order to restore some value. And hopefully we'll have good news coming, because so far it has been an avalanche of bad news. I mean, every day we had some adverse news. Today as well, inflation data are of course changing.
That's not, you're hoping for good news, but you actually have to put money to work without the hope. How much are you having to rejigger your risk models and having to revalue the portfolio based on risk? Yes,
so we have indeed, we had faced with multiple new parameters, and what happened in the UK actually is quite decisive as a role model. So what's new is super high volatility on rates, on currencies as well, something we've never seen before actually. A correlation very high between asset classes, so between rates, credit, equities, which is something not that usual. We need to go back to the 70s or early 80s to see such a pattern. And lots of uncertainty everywhere, geopolitics, earnings, price action on commodities. So indeed we had to restrike in a way the way to build portfolios, to be more defensive, to be more quality. We just went more constructive and overweight on long-dated bonds, govies, which are offering a good value, and equities. It's a sort of rotation between countries, sectors. So there's still value. There is not value to be extracted. But you're right. You have to say that it has been a brutal quarter.
It certainly has. Vincent, let's just talk a little bit about that long-dated bond market. Here in the UK, we've seen a little bit of volatility this week in that space. The central bank has had, 100 basis point moves. You don't usually get that in a 30-year. No. What it has raised is the spectre of financial instability. How worried are you about financial instability and the fact that central banks and others are having to step in to deal with it.
Yeah, indeed. For me, the UK dramatic, in a way, experience of this week is a kind of a warning of what can happen in the next quarters or years in Europe or in the US. So meaning a tug of war between inflationary pressures and concern on growth, and some fiscal spending by government to support growth and to lower inflation. And in this context, indeed, central banks will be torn between several priorities, and we expect, and what BOE did finally to restore some stability, that central banks will come to the market, play a kind of yield curve control, like in Japan actually, to keep long-term rates at reasonable level and to keep real yields on the medium-term horizon at around zero. Mm-hmm. Because our economies cannot afford to have very positive real yields. And that's why we are more positive on, let's say, 7, 10-year, 30-year bonds, is because we believe central banks will act on it, given the very bad dynamic on growth, and therefore forget, in a way, about quantitative tightening. We don't believe it will happen big time. Central banks will probably pause on it.
Is the UK investable at all right now?
That's a very good question, because it's the debate we had internally. Not yet, to be fair. There are multiple variables in the equation that are still unknown. There are some big imbalances which have been built. Nevertheless, some situations in the equity space are becoming very cheap. So we are looking at it again. The big question is around the pound. What is the fair value of the pound? So we believe the pound is still a little bit overvalued, but not that much, but a little bit. And the gilt market is, given the price action we just had, it's very difficult to be invested into it, to be fair, for the time being. So hopefully it will clarify in the next week. But short term, we are a little bit cautious away from this market.
Yeah, it's really hard to see an investment case short term for that. Vincent, thank you very much. Vincent Mortier, Amundi CIO, thank you very much. Coming up, UK Prime Minister Liz Truss is sticking with her controversial tax cut plan. So we're going to talk to Ian Mulhern, a Tony Blair Institute chief economist, about that strategy. This is Bloomberg.
when business news breaks.
The IMF calling out the UK on fiscal policy.
A shot across the bow to the whole Liz Truss administration.
The Bank of England acted amid concerns a Wednesday cash call would trigger gilt crash. John, I've never seen that headline in my life.
Trust Bloomberg for the fastest coverage and instant expert analysis.
They're doing it to try and stabilize the market, but they're having very little effect.
The term is kind of quantitative conundrum.
We are now in chaos.
For continuing coverage, keep it tuned to Bloomberg Television and Radio.
The government's got to accept what they produce. So, although people may have worried that she was sort of downgrading the OBR, less convinced about the Bank of England, I think this has been a reality check, and if anything, the strength of those institutions to say this is how we're going to act, and you've got to adjust to it, is greater.
So John Geefe, former Bank of England Deputy Governor, speaking to Bloomberg a little bit earlier on. The strength of those institutions, I think, continues to be tested. The OBR, the Bank of England, Prime Minister Liz Truss's government signalling today that it is going to stick with its plan for tax cuts. There was a meeting today between the Prime Minister, the Chancellor, and the head of the OBR, the Office of Budget Responsibility. There was some expectation in the markets that out of that meeting you would see a bringing forward of the OBR scoring of the mini-budget that the Chancellor produced last week, and potentially some changes to it. Now that has now not happened, and we're going to have to wait until November for the details to come through. Ian Maheim, Tony Blair Institute Chief Economist, joining us now. Ian is a former economic advisor at the Treasury, so he's got some insight into how the process works. Ian, can we afford to wait for the OBR to produce its verdict on the government's economic plan until November? Do we not need it sooner? If we don't get it sooner, what do you think the implications are?
Hi, Guy. I think you're right. I don't think we can afford to wait that long. I mean, let's put this in context. Last week, the government embarked on the biggest tax-cutting budget for decades, and it said that it was explicitly designed to boost growth. It was supposed to be a macroeconomically significant event, and yet it stopped the Office for Budget Responsibility from providing that macroeconomic forecast that would have corroborated or indeed challenged its claims. And that's why we've taken the step of producing a forecast that tries to fill that gap. And what we found is that growth over the next 5 years under this package is only likely to be less than 0.1 percentage points higher over the next 5 years than it would otherwise have been. And that will indeed boost some tax revenues. So you can expect in 5 years' time to have tax revenues about 6 billion higher as a result. But that effect is swamped by the direct cost of the tax cuts at about 45 billion, and the increase in debt interest that is coming from higher gilt rates and higher cost of debt service for the government, which is going to cost them about £20 billion a year by the end of the forecast. So all in all, this is leaving a big fiscal hole, and the government has a credibility gap it's got to close.
Ian, what does it do to inflation in your forecast?
Well, inflation was reduced significantly measured inflation was reduced significantly by the government's intervention on energy bills, where it's promised to freeze those energy bills. And so we see inflation peaking a bit lower than it would otherwise have done, perhaps a little bit over 10% later this year, and then it will come down. So in a sense, inflation is less of an issue, but of course, the fiscal pressure that the government added on last Friday is going to cause the Bank of England to have to respond more sharply so that monetary policy neutralises that fiscal stimulus.
If there were to be spending cuts, what impact would they have? And I know that's a kind of very abstract question, but there is now talk that each department is being asked to consider spending cuts. Is that the logical response to the mini budget that was announced? Is the other side of the ledger spending cuts? And if not, what should be the logical response to it?
Well, it's interesting. There's been a lot of discussion around that the government is going to have to do something in order to stabilise the level of debt to GDP. We actually don't think that's going to be necessarily essential, because we see debt topping out at about 98% of GDP towards the end of the forecast in about 5 years' time. And so it seems likely that debt will, in any case, stabilise. But the problem for the government is that it's going to be borrowing by then huge amounts to fund the current deficit, that is spending on day-to-day consumption and day-to-day government expenditure. And that is not sustainable. So the government will have to do a fiscal consolidation. And it's really got four options here. It could cut services, but with public services in the UK looking pretty threadbare, that is going to be political suicide, I would guess. It could cut benefits, but in the middle of a cost of living crisis, I think that is also politically extremely difficult. It could cut capital spending, but if it did that, then it would undermine the government's claims to boosting growth. And so really the only other option is to find more tax revenue and probably to walk back at least some of the tax cuts we saw last week.
Is there any additional measures, though, that the government could do at this point that could actually help materially boost growth, like meaningful supply-side reform? Like, could that be coming down that could really help?
I think it's unlikely that the government will be able to do anything, at least in the short term, that will boost growth significantly. It's got a couple of options that might make a difference in the long run. Some